Thanks for joining us at this Magellan update. Today I'm speaking with Hamish Douglass, our co-founder, CIO and portfolio manager. Hamish, 2018 started with heightened volatility in general global equity markets. What's your take on what's happening?
Well, first of all, we have to start with, in terms of equity markets and asset prices, a fundamental driver of the valuation of assets is long-term interest rates, and particularly long-term risk-free interest rates. We then have to think about the world we're in and what the central banks may do. We're at the end of a huge monetary experiment. We don't know what's actually going to happen, but at the end of a very long economic recovery, particularly in the United States, we've had 88 months of job creation. This is the longest period of job creation in history. The unemployment rate is now back to 2005 levels. It's down at 4.1% in the United States. Interest rates around the world, still a third of the world's bonds are trading at negative yields. So we've got a synchronizing global recovery. What is a big factor that's just happened is, in the United States, President Trump has enacted massive tax cuts. They're worth slightly under 1% of gross domestic product for the next 4 years, and it's extended longer than that. So they're adding effectively money going into the economy, nearly 1% of GDP, and on top of that, there's some additionally budget expenditures that have been agreed by Congress worth nearly, for the next 2 years, another 1% of GDP. So they're adding fiscal stimulus at the end of an economic cycle. The risk here, not only do we get accelerating economic growth in the United States from this activity, but we start to get inflation. So what actually happened on the 2nd of February, they released the January jobs data, and in that jobs data, they released something called average hourly weekly earnings. And they had increased it at the rate at 2.9%. And that was the highest rate of increase in wages since June 2009. The market got spooked that the central banks may be behind this curve. And if they're behind the curve, that may make interest rates have to go up higher and faster than markets are anticipating, and ultimately long-term interest rates could go up materially higher than the market has previously been anticipating. I think this was a canary in the coal mine. We had already been taking action in the portfolio, increasing our cash weighting through December and January before this had happened. We became increasingly concerned of the experiment of adding fiscal stimulus at the end of an incredibly long economic expansion, with all this quantitative easing in the world and some actions that central banks are taking. If it turns out that inflation does return in the United States this year, I would say hold on to your chairs about what could happen in the bond markets and ultimately happen in the equity markets. The other thing I'd say is nobody knows. We don't know whether inflation will come or not, but you cannot ignore the fact of what's happened with quantitative easing, which is on a scale the world hasn't seen, and adding fiscal stimulus at the end of the longest economic expansion nearly on record could produce outcomes that could cause the central banks to be behind the curve and force them to tighten monetary policy faster than is required. It isn't inconceivable here that we could have, if that happened, if it happened, and we would put it at a 50-50 probability, which means I don't actually know, but if it was to happen that we get more inflation in the United States and the central banks had to act more rapidly, or the markets have a view that they will be forced to act more rapidly, I don't think it's inconceivable that we could have a 20 or 30% market correction. But I would put it at 50-50. So some real caution is required here.
And so given that context, how are you positioning the global strategy at present?
Well, we're cautious, Frank, at the moment, to be honest. We disclosed at the end of January we'd increased the cash weighting in our strategy, in the global equity strategy, to 12% of the portfolio. We've been taking risk off. We have for some time been very underweight what we would call low volatility defensive equities like consumer staples. And we'd further reduce some of the weight in that area over that period, because if bond yields go up, they could be very sensitive to that. And those stocks have actually underperformed very in the last few months as this has been occurring. But we're also looking, if there is a big shock in markets, we're looking at maybe some cyclically affected areas of the world. Obviously, cyclical stocks are doing very, very well because economic growth is synchronized and strong around the world. But if you've got a large wealth effect with a market correction, you have to think about your portfolio and how it's weighted at the moment. So on this issue of bond rates rising, we have been underweight that area for quite some time. We've been increasing our cash our cash weighting. I'm not going to tell you what we've done after the end of January, but we're pretty defensively and cautiously positioned in the portfolio. But we have still got a meaningful weight to some major technology names. That is not an area we've actually been trimming, and we don't actually think they're very exposed cyclically to economic downturn, nor are they that sensitive to this bond rate issue we're talking about. That doesn't mean in the short term their share prices couldn't come down if markets were to react, but I think the fundamentals behind many of those companies for the next 3 to 5 years are incredibly strong.
Hamish, there are plenty of commentators that are suggesting that US equities are overvalued. The strategy that you manage is obviously well exposed to US equities. What's your conversation around the valuation related issue?
Well, first of all, I would be sceptical about the people who may be pushing some of those things, that they may be pushing a barrow that they're pushing there. All markets have been near all-time record levels. So I don't think any market is immune, that we're in an environment where we had super low interest rates and markets across the world have performed very strongly for the last few years. So let's put it across the board. The US market on a 1-year forward price earnings ratio is trading at about 1 point above what the world markets are trading at. So the US isn't in a completely different zone to where the rest of the world happens to be trading. But it's not actually how we look at things. So we have got 22 investments in our global equity portfolio. We're not buying the whole US market. Of those 22 investments, we've only got 4 investments that are domestic investments in the United States. We've got Wells Fargo, a major bank in the United States, Lowe's, the major home improvement retailer in the United States, Crown Castle, a communications infrastructure business in the United States, and HCA, the largest hospital operator in the United States. If we look at those businesses in aggregate, they're trading on an average multiple of 13 or 14 times earnings at a substantial discount to world markets. So where we've chosen to be in the United States, we're not paying high multiples of earnings or anything for our domestic exposure. We see a lot of value in that space that we have in the United States. But outside of the United States, we have 2 domestic plays in the United Kingdom. We have Tesco and we have Lloyd's. But they're less than 4% of our portfolio. The vast majority of our portfolio are 16 multinational businesses. They could be technology businesses. They could be our quick service restaurant businesses like Starbucks and McDonald's and Yum Brands. They could be some healthcare companies. There's some consumer staples in there. We've got 2 consumer staples. Some of those are listed in the United States. Actually, the vast majority are because of the weighting in technology, and some are listed outside the United States. We don't regard them as US businesses. And actually, we don't find any evidence that a multinational listed in the United States is more expensive than a multinational listed in Asia or in Europe. We will own them wherever they're based. That doesn't worry us. We're buying multinational exposure of some of the world's best businesses where we see value. So this talk about we've got this portfolio, it's all in the United States. We have 4 investments in the United States that I regard as US investments. We've got 16 multinationals. And there's no evidence that multinational businesses trade cheaper when they're listed in Asia or Europe as opposed to listed in the United States. And actually the ones we've chosen, I could point in ones in Europe and Asia that are actually trading at materially higher valuation multiples than comparable businesses in the United States at present.
Thanks, Hamish.
A pleasure, Frank.
And thank you for watching. As always, feel free to forward this link on to colleagues or clients that you think might be interested. Thanks again.